Let's get a look at the bigger picture. Mike Horwath is with us, Chief Investment Officer at Diversified LLC. Thank you for being here. Mike, some of your thoughts on the action we're seeing. I have a lot of folks coming on and saying they're in this wait-and-see mode, but not panicking.
Yeah, we're in the same boat. Thanks for having me, Nicole. A lot of what you just said makes a ton of sense when you look at the numbers. The sentiment data is concerning given, that pullback and the uncertainty in markets. But everybody knows uncertainty is not good for markets. So a lot needs to be figured out. But when you look at the hard data, you look at the underlying fundamentals, there's a lot that still looks really good, whether it be the labor market, corporate earnings, corporate fundamentals broadly from a revenue, from a margin perspective. So there's still a lot to like. But naturally, when you have sentiment like this and some pullback in markets, I think people start to question a lot of that hard data.
Right. So at this point now, are you expecting more volatility? And I had someone who was talking with and said, more likely to sell into the rallies than I am to buy on the dips. Or maybe you're on the other side of that.
Yeah, I'd probably be on the other side of that at this point, Nicole. And I think, the comment that big tech may be one of the first places to rally back is something we're looking at as well. You look at forward valuations on some of these names at the top, more like Google, Nvidia, some really strong names that have pulled back and from a valuation perspective and growth perspective still look really strong. So, it might be an opportunity to kind of lean into those areas rather than selling as markets rally back. So from our perspective, we still see a lot of things we like. We would probably be buying on dips. We do think while we've been leaning away from the Mag 7, this type of pullback that's been pretty concentrated in those top names, when you look at the sector level and the specific stock level, it's an opportunity to probably jump into markets and buy as things start falling down.
Yeah. As I'm reading about the recent Atlanta Fed GDP estimate, and really when you think about what is a recession, right, it's 2 consecutive quarters of negative GDP. And, do you think that's likely to happen?
I think it's probably a higher probability than it was, call it 3-4 months ago, at least on what we would believe at this point. But I think the Fed numbers are a little tough from the Atlanta to measure because some of it's real-time data when it gets incorporated into that measurement. And one of the things we saw was that net imports really drove a lot of that fall. So we want to see what the reversion looks like if people are front-running tariffs and importing more to try to get ahead of it, what the change will be when those numbers are reflected from an inventory or sales perspective.
Right, understood. So when you talk about the sector trends, you did say you agree with the statement that it's likely to be big tech that could rally back, and names like Google, you said Alphabet, and Nvidia were names that have been beaten down. And we've seen these names, for example, Google's about 20% off its highs, Nvidia is about 30% off its highs. What other sectors and trends are you watching?
Yeah, coming into the year, I would have said we've been trying to lean away from the Mag 7 a little bit, look into areas like financials, maybe a little energy, industrials, even consumer staples, right? A little bit more high quality, dividend focused equities, not as high growth. You fast forward to today, all of a sudden, we're starting to keep an eye on the discretionary in the tech sector, and mostly just because, these things have fallen down quite a bit. At the sector level, most of the sectors year to date on the S&P are positive. It really comes down to discretionary and tech and their outsized weighting in the index that are really pulling these things down. But some of those names, like you just mentioned, right, Alphabet, Nvidia, on a forward-looking PE perspective and growth rates, they're starting to look much, much more reasonable. Not every name is like that, right? But the names like Broadcom and Nvidia that kind of move in lockstep with everything going on in the chip industry, there are areas that we're certainly looking at now that maybe coming into the year, the conversation was the other 490 or 493 names. Well, what about these other 7 or 10 now as they start to pull back, maybe starting to lean back into them and get a little bit closer back to the benchmark weight, if you will.
Right, understood. I was reading about Jamie Dimon selling off JP Morgan stock and Warren Buffett shoring up a record amount of cash. And then over the next 18 days, that stock sold off. The NASDAQ 100 crashed 8.8%. JP Morgan fell over 9%. I'm not implying that they were manipulating the market, but more just, making moves and being who they are and probably either hedging or maybe that was a scheduled sale when it comes to Jamie Dimon. But the record amount of cash from Buffett, he's actually up year to date while everything else is down, right? I mean, what does that say?
I think a lot of it comes down to, Nicole, there's not a lot of bargains out there right now, and at least, especially going back a couple of months. You look at JP Morgan stock, when you look at the rally it's had, regardless of your belief in the company, there's an element of someone like Jamie Dimon probably needing to de-risk how much of a weighting he has to the stock and how well it's performed. It's probably prudent to try to take some of that. And from a Warren Buffett perspective, he's not going to overpay for things. He will be patient. And given where, whether you use kind of the CAPE ratio or traditional forward PE or, price to book, whatever kind of valuation metric you want to use, markets are not super cheap. And I think finding stocks at really reasonable prices that he finds attractive, that he can lean into, given the size of what he has to move, he's going to be patient, right? And we're not surprised by that. But I think it's something to monitor, right, of people who have done this for a very long time and what they're doing. But after markets rallying for the last almost 15 years, right, it doesn't surprise me to see someone like that really, picking up the cash pile and just waiting for something a little bit more attractive to jump into.
Right, understood. Now we're getting some headlines about Ukraine being ready to accept the U.S. proposal for 30-day truce. The U.S. cancels freeze on the intelligence sharing that they had. Look, it's been a very, very tumultuous relationship, a difficult situation. We are watching the markets now. It appears they're coming back here some. Your thoughts on the way the market's moving to the headlines, maybe to this exact headline where the Ukraine took important steps towards restoring durable peace and Ukraine expressed readiness to accept the U.S. proposal to enact immediate interim 30-day ceasefire. Your thoughts?
I think a lot of it's just trying to clean up uncertainty, Nicole, right? So much has been out there from an uncertainty perspective, whether it be the Middle East, Russia, Ukraine, now tariffs are a huge weight. And we haven't even started talking about China, Taiwan, and at some point that will have to become a conversation because that is overhanging a lot of things right now. So anytime we start to see these geopolitical, conflicts start to maybe resolve themselves or start to move in the right direction, I think it's just a level of uncertainty that, I think investors will appreciate. And you can start to kind of price in a little bit more of a normalcy, although, naturally these things can ebb and flow from a geopolitical side.
Yeah, well, we're definitely, ticking higher on this news. So let's see what happens here. And thank you for the conversation, Mike, and your outlook and the opportunity there to buy the dips, maybe. Mike Horwath, thank you. Chief Investment Officer of Diversified.